how to be mortgage ready for a pre-construction property. Hello everybody, my name is Preeti Rao and thank you so much for tuning in. And if you are new, welcome to my channel, where we try to cover topics that are of interest to you on real estate and mortgages. So please make sure to like, share, and lightly hit that bell icon so you get notified anytime I share an informative video for you. And of course, if you find the information provided of any value, all I ask is to hit the subscription button to get me motivated to keep you up to date with everything real estate. Hi, my name is Preeti Rao and I am a real estate broker with Search Realty and a mortgage broker for close to 20 years. Today, I'm here to answer another frequently asked question when it comes to pre-construction: how to be mortgage ready. I know mortgage can be the most boring topic to discuss, yet it has so many permutations and combinations within itself, making it quite fascinating if you are the analytical type. If not, it can be quite overwhelming, especially since the mortgage requirements never sit still. They keep changing as per the applicant's situation. So how to be mortgage ready when you're buying a pre-construction property? Now, for those who have already bought a pre-construction property, you are aware of the fact that you need to provide a mortgage pre-approval letter. In this scenario, you either go to a bank or your mortgage broker and submit your income and financial documents to the bank or the mortgage broker, who then will process your application like it's any regular application that's come in. They will do a credit check, look at your income, and then if everything looks good, they will give you the pre-approval letter. The drawback is that this pre-approval letter is mostly valid for 120 days only. Now, there are some financial institutions that will honor their pre-approval letter at the time of closing, which can be 2 to 3 years later, but not all banks follow that. So what happens to that pre-approval letter after 120 days? Well, it kind of sits pretty in your file at the builder's office, giving you that check mark, for compliance complete. And that is the one and only job of that pre-approval letter. Now you must be thinking, well, that's great, but what about the actual mortgage? See, this is why the pre-approval letter is important and mandatory. When you go to see a mortgage broker for the letter, they get an insight on how your credit and your financial situation is, and they can actually guide you properly on what you need to do to be mortgage ready when the time comes. So what are the factors that you are looking into when it comes to for a mortgage pre-approval? 1, your credit score. A lot of people don't understand how this credit score works. And yes, it's a huge topic that I will cover in another video, so stay tuned for that. But when it comes to an approval or even a pre-approval, your credit score decides everything. This can make or break your deal. An excellent score is anywhere above 680 plus. The higher, the better, mostly. Because along with the score, the bank also looks at your debt load you have. So if I check your score and you have a score of 820, but no credit cards or no debts at all, that can be a bit of an issue, especially if you're not a newcomer. The bank wants to see how you manage your debts. And if there are no debts to see, then that puts your file in a little bit of a jeopardy. The good thing is that with a pre-approval construction mortgage, we are talking about today, so we have a lot of time to properly build your credit. The same rule applies if your credit score is below 680. You have time to repair it. Talk to an expert mortgage broker and they will guide you correctly. The second point, income to debt ratio. What does that even mean? Income to debt ratio is a ratio of putting your debt service as a percentage compared to your income. There are 2 income to debt ratios that are calculated. The first one is your GDS, also known as your gross debt service. This is calculated by taking into account your annual mortgage payment along with your annual taxes, heat, and 50% of maintenance fee if applicable, and divided by your gross annual income. The maximum GDS percentage cannot exceed anywhere from 32% to a maximum of 39%, subject to your credit score. The second income debt ratio is the TDS, also known as the total debt service. This is calculated by taking into account the GDS, which is your annual principal, interest, taxes, heat, maintenance, plus your monthly debt payments and dividing that by your gross annual income. The maximum TDS percentage cannot exceed anywhere from 42% to a maximum of 44%, all subject to your credit score. To a bank, you are an applicant that needs to fit in that pretty little GDS TDS box in order to qualify for a mortgage. And when it comes to pre-construction, you have the time to work towards making that happen. Point number 3 that you have to keep in mind is the job category you fit in. Banks love salaried employees. It's easy for them. Pay stubs, employment letter, T4s, they're done. Easy peasy, right? The challenge comes when you are self-employed or you're on contract for less than 2 years. As a self-employed individual, it is notably more difficult to secure a mortgage. The nature of being self-employed is that your income fluctuates yearly. Plus, with the allowable deductions, what you earn is quite different from what you declare on your taxes, making it look like you earn far less than you actually do. That makes it very difficult for you to fit into the GDS TDS box, because the banks will take your personal notice of assessment for 2 years and then average that out as your annual income to figure out your debt service ratios. Sometimes they will add back 15% to that income, but that's up to a bank. So always talk to an experienced mortgage broker before signing any real estate deal, pre-construction or otherwise. Point number 4, the down payment. Now, by the time it's time to approach the bank for the mortgage, you would have already paid the builder the required down payment, which is typically around 20%. So you don't really have to worry about proving where the down payments come from. But the bank will ask to see the copies of the check given to the builder, and those checks have to be from your personal account. They can be from your business account too, if you are self-employed, but banks typically frown upon that. The reason why they ask to see copies of the checks is to basically see where and how you were able to pay that money. If the checks are from your regular checking or regular savings, then we've got nothing to worry about. There's no issues there. If the checks are from your line of credit and that line of credit has been paid off, no problem either. But if there is a balance owing on that line of credit, that will be calculated towards your TDS. So always be aware of where the down payment is coming from and consult your bank or your mortgage broker on how to deposit the money correctly. So now that you know the 4 main points that you have to be diligent about and be aware of when going for a pre-construction mortgage, the only advantage you have is if you are behind on your credit score, you have time to fix it. If you are low on your income or down payment, you have time to improve it. This is the only way to be ready for a mortgage when it comes to pre-construction. Be aware of what you need to work towards improving, what's lacking, to be prepared by keeping in touch with your mortgage broker in case any of the rules change along the way. So, if you found value and you liked the video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Be sure to hit like, share and subscribe and the bell icon so you don't miss any future videos. Thank you for watching, and don't forget to call me because I hold the key that opens the door to your dream home.